Welcome to Tweener Madness, the high-stakes startup showdown where 8 promising companies go head-to-head for a $25,000 investment prize from the Triangle Tweener Fund. But before the competition kicks off, let's meet the people making the tough calls, the judges. In this special Meet the Judges episode, we're sitting down with the investors and industry leaders who will be asking the hard-hitting questions, evaluating the startups, and ultimately deciding who moves forward in this bracket-style competition. Each round, 3 judges will vote on which startups advance, leading up to the finals in early April, where one company will take home the top prize. From the judges, you'll hear about their backgrounds, what they look for in a winning startup, and maybe even get a little inside scoop on their decision-making process. So, if you're a founder looking for investment, an entrepreneur curious about what investors really want, or just someone who loves a good business battle, you are in the right place. Let's meet the judges. Here's your host, Scot Wingo.
Hey, Tobi, thanks for joining us today, and thanks for being on the selection committee for Tweener Madness.
Thank you for having me. I'm very excited about it.
Yeah, it's going to be fun. So it's going to be a March Madness style kind of competition with some startups pitching. And it's going to be fun to kind of see who we get and how the different selection committee members react to the different pitches.
So our sports metaphor or something, this March Madness or April crazy.
You've been here long enough that I know you know what that is now. Yeah, so you can't play the new card for like 15 years at this point, or however long it's been. So that's actually a good intro. You don't sound like you have a North Carolina accent. Let's walk through where you're from, how you got here, and I know you have an entrepreneurial background. Let's talk about that, and then we'll jump into the investment side.
Sounds great. Right. Yeah. So for whatever reason, after 15, almost 16 years out here now, I guess at least I don't get a Southern accent. We'll see if the next 15 years will do the trick, or if this is what I'm stuck with for the rest of my life. But I grew up in Germany, went to school over there, went the business school route. I remember graduating from business school, people said, are you going to do consulting or investment banking? Those were the only 2 options, it seemed like back then. I picked investment banking, sat in Morgan Stanley's M&A department for a year. And it took me apparently that long to figure out that there had to be something more than the world to do than filling out the same Excel sheet in the same cubicle over and over. So I got bitten by the entrepreneurship bug back in 2006. I joined 3 guys in Berlin, Germany, that were just starting basically the German Facebook. 2006, the very early days of social networking. We were crazy lucky in market timing in that we were the first social network in continental Europe, with a little bit going on in the UK, and then, of course, a little bit in the US with Facebook, and VKontakte in Russia, and China had their first social network and the like. Anyways, fell in love with entrepreneurship there. That fast pace, the constant roller coaster every day. That German startup sold very quickly after a couple of years, and I reconnected with a dookie, Taylor Mingus, who's also still in the area here. He said, do you remember this idea I told you about last summer? He worked with us at that German startup while he did a Duke in Berlin program. And he said, I think I'm going to go ahead and do it. Why don't you come over here and we'll do it together? So that was my cue to pack 2 bags back in 2008, 2009, and said, why not live in the States for a couple of years? and then life happened. So ran this company Shoeboxed together with Taylor for about 10 years. We sold in 2018 to a Texas-based private equity fund. And Shoeboxed quickly was a fintech company. We digitized receipts, bills, and invoices and kind of paper financial documents. Sold in 2018 and took a year off after that, and then joined my now partners, Tim and David, at Co-Founders Capital to try and invest in more early stage B2B software ventures.
Yeah, I remember like really early hearing you guys at Shoeboxed, and there was an element where you were going to build a social network off the receipts. So people would scan in their receipts, then you could like build their social network from there. I don't know if you guys ever were able to execute on that. I think you went some other directions, but like you went more fintech than social network. But I remember it being like a really kind of clever. You guys did like a lot of clever stuff in there that was really neat.
Yeah, there were, I would say, the first 2 years were a lot of pivots. Social shopping was one of the big ones early on in that networking idea. And a long time thought was that receipts hold very interesting pieces of data. They're the only document that tells what people are buying or what they own. And so, you think about use cases, and especially us coming out of the social networking startup, I think the thing we all realized there was it's not new things that we're doing with technology or in online businesses. We're just replicating things that are already happening, and we're making them easier for people. So one of the thoughts was, you might have this idea of show me a pair of jeans that a lot of investment bankers in New York are wearing, but nobody at Duke has yet. So there were some fun experiments in shopping stereotypes and what we could tell of people based on their receipts. But it didn't really fly. At the end of the day, there was this thing called SaaS that we discovered, where it was frankly an eye-opening moment to us in 2008. There were some people that said, if you could do X, Y, and Z for me, I would pay you for that. And we went, wait, you can do online businesses that are not just based on advertising revenue? That's pretty cool if somebody would actually pay you to use your website. We later learned that that's called SaaS.
Yeah. Mm-hmm.
And I think it's become a pretty big thing.
Yeah. The early days of SaaS. It's too bad you didn't have all the receipt data now, because some LLM would buy it for trillions of dollars. So you were too early. You guys were way too early. Well, we don't have receipts anymore either. So maybe your timing was actually pretty good.
But that was interesting. Like, we dug around a lot on, right, what is that data worth? We had hedge funds that were interested in trying to figure out how much GoGo in-air is charging now, and would do that based on receipt data and the like. So yeah, we always thought we had very interesting data, but there weren't a lot of people that were paying for it, except for some of the folks, even back in the day on OCR training and regular expressions, before a lot of ML and whatnot, that were trying to buy some of these data sets. And we also had individual inquiries where somebody needed to fill out an expense report, but lost that receipt. And they basically said, could you give me a receipt for $50 from Uber in New York? I can just submit it. So we thought for a while about if we sell individual receipts to people. We also had, I think the best T-shirt idea we ever had was a shoebox shirt that would say, "We know what you bought last summer." But that is, I guess, a little too sketchy.
A little too scary. So you went to the dark side on the investing side in 2018 and joined Co-Founders. And I think they were on Fund 2 at that point. Is that right? Yeah.
That's exactly.
Yeah. And that was around a $30 million fund.
Exactly right.
Yeah. And then, the career path at VCs is
maybe a testament to the area and this network here. So my general counsel at Shoeboxed, Glenn Kaplan, still my favorite attorney in the world. While we were going through the exit at Shoeboxed, he was the one who said, hey, you probably haven't met these guys because when they started their fund, you had already raised your Series A at Shoeboxed. But I remember his line was, David and Tim tend to see almost every B2B SaaS deal in North Carolina. They sometimes need CEOs, CFOs, advisors, board members. I think I should connect you if you want to stay in the B2B SaaS space in North Carolina. That might be a really good connection. So he made the initial connection, and I really wanted to take a year off before I do anything. We kept chatting over that year, and it really came to be a fit on the fund side of things.
Very cool. And then, so give us the quick pitch for Co-Founders Capital. Like, what do you guys invest in? What's the sweet spot? And what are some categories you don't invest in?
Yeah, absolutely. So I would still describe Co-Founders as a fund made up of all former entrepreneurs. And I think that does something, right? So we have all ran B2B SaaS ventures and at times multiple times over. And we really wanted to give more capital to the early stage entrepreneurs, especially in our geography here. David, I think, put it so fittingly when he started the fund in 2015, where he said, I think it's ridiculous that we make our founders in North Carolina raise their pre-seed or even their seed rounds a $20K angel check at a time. There isn't a good institution that kind of gives out $500K, $750K, maybe $1 million checks early on. And so what that does is that people have to pick out these individual angels. And in his mind, that's how we lost a lot of companies in this area to the Bay Area, Boston, New York, because, Duke or UNC grad might show up there and the VC might hand them $1 million check just on the idea on a napkin, right? So that's what we stay true to today. So co-founders, it's a very early stage B2B software investor. We tend to like it a bit better when companies are at revenues. For pre-revenue companies, we would say that we likely need to know a market intricately well. So chances are that either one of us would have had to run a company in that space before, or we have a lot of our investors maybe out of a specific area. But then we would typically fund companies, say somewhere between 50K and $500,000, maybe up to $1 million annual revenues. We tend to write $1 million, $1.5 million checks up front. So that's most often the seed round. We lead those rounds most often. So it's typical that maybe somebody might raise a $2 million round, just having had their first revenues. And those are the ones that we typically lead. We like to be very active investors. So what we look for too is entrepreneurs that want a sounding board of former entrepreneurs. We are very clear cut that we will not make management decisions. We're here to advise and recommend, where we tell our CEOs, look, you have a team of former B2B software entrepreneurs. So chances are we can help you, be it in hiring, in selling, in pricing, in raising the next round, or whatever it may be. But it's up to you how you use us, right? We're here. We can spend our time on you. We like working hard. And if we can make anything happen with you, even better. So that's what we try to do.
Yeah, and implied in kind of leading a seed round is it's usually a priced round, and you're going to take a board seed and be pretty involved in the company, and being local really helps a lot, right? Because you can just have that face-to-face meeting a lot of times, where I find Zoom is just like really hard to coach an entrepreneur through, and just like not as impactful as one-on-one kind of interactions.
I think that's true. It's funny. We're still sticking to this geographic thesis. Even post-pandemic and post a much more hybrid or virtual work environment. And we certainly have companies where one co-founder might be in New York, the other one is in Durham or the like. But with that said, we still see advantages to being local. It's on the one hand what you said, in-person conversations certainly have something to them. The networks we have are most local, and I think there's always a different push on helping somebody who is local. So here we can introduce our entrepreneurs typically a lot more to other entrepreneurs in their vertical or in their field. We have better customer connections out here and can go around with somebody and try to find the first 3 to 5 customers and actually join them on sales calls and do that locally here. So I think there's a lot to be said for continuing to do things locally.
Yeah. And then, so David kind of answered for the firm already, but like for Tobi, so the deals you have kind of, and I don't know how it works at your firm, like the ones you got behind and sponsored and are on the board, and it may be too early because this venture game is a long-term game, but what's been your biggest exit or wins that you've had?
Yeah, so on the firm in general, we had a couple very good outcomes above the 200 million mark. Element 451 was the most recent one just a month ago in Raleigh, a massive outcome. That was one of our Fund 2 deals. A couple of years before that, we had the same with Second Nature, the former Filter Easy in Fund 1. So those are certainly the ones that make headlines. It's interesting, however, again, I think there is a lot to this idea of former entrepreneurs and how we tend to think alike. I think there was a lot of what clicked between Tim, David, and myself when we started chatting earlier on, and we had the same confusions why investors might not do this or that, or we found maybe this or that ridiculous of how other VCs acted or the like. One bigger area was I always took issue with investors calling a 30 million or 50 million exit a mediocre failure. In my mind, I mean, certainly if you raise 30 million bucks out for 30 million, that might not be a great outcome. If you can create a 30 or 50 million exit based on 1, 2, 3, 4 million in funding, it seems like that's true value creation and something that should make everybody's dreams come true. So what we try to do here is go absolutely not at the unicorn or bust, right? Not just the power law of venture capital and not just the I'm going to write 50 checks, and as long as one of them is a unicorn, I'll probably be okay. We look at it very individualized. And so we look at businesses too that some people might call not on a venture fundable scale. And we'll go back to entrepreneurs at that point and say, well, look, based on your market, based on your go-to market, whatever it may be, our expectation is that you're probably going to get to 5-6 million revenue, but maybe not a ton more in the next 4 or 5 years. So let's think about that. If that's the case, you might exit for this. And for us to make our returns, we might need to own 30% of your business. Now, that's a hefty ask, and it's up to you whether you do that or not. But I still think these can be figured out that way. And so the reason I bring this up is, while these big exits are the ones that make the news, we've had outcomes that were significantly smaller in purchase price, where we as the fund made the same return than those 200 million and top outcomes. So I still like the idea of, I'm going to do a portfolio and 80% of them will go bankrupt. Our venture partners still tell us every now and then, you can't save them all, but somehow we're still trying to make every single one a W.
Yeah. And it's also, a lot of the one theory is you look at IRR, which has got a time element too, right? Like, so a monster return after 15 years may not actually beat a short return for 3 years for a 30-minute exit because of the time factor, which is the future value of a dollar is a real thing and important. How about some investors keep an anti-portfolio, which is a list of companies they could have invested in, but either missed it by timing or said no, and they probably should have said yes. Do you have any of those that kind of linger with you?
Not that linger, I think, for a long time. I think there were certainly some where you think back and you say, yeah, we should have offered a bigger valuation here so that not somebody else got the term sheet, or would have loved to work with somebody there. But I would say it's less so for us, because we still try to be at a pretty high deal pace, doing maybe 5, 6 or so investments a year. And frankly, and now after a little over 5 years in the seat, I think I've gotten humble enough to say, when we pick an investment, we don't know if that's a zero or a big win. We'll know in 10 years, might have a few, but we're so often wrong about our picks too, that I think the thing that's interesting is, if something gets away, you still think about it as there's nothing to say that it would have worked out, right? So I can make the bet somewhere else too. It's we're still going to deploy the capital somewhere else. But with that said, there were certainly ones that looked super cool and super interesting. We might have gotten too late. The one I remember locally was Social Institute. Laura, now I forgot her last name, but we got in that, I think, pretty late as she was raising, and she was just wrapping it up. I loved everything about that business, which was teaching kids how to use social media, basically, right? Doing that in a really cool way, how kids actually enjoy doing so. I've seen overall some really good missions where I would have loved to support them, and sometimes maybe they didn't fit in the fund because it's a bit more B2C-ish than the B2B stuff that we told our investors we would do, or it's a little bit too late or too early stage. So there's certainly a lot of others that I cheer from the sidelines for. But we also tend to say, in a very genuine way, we still go back to saying, well, look, we're always happy to meet with any entrepreneur that's local around here to see if we can help. Chances that we also invest in that company are slim, because we make 5 to 6 investments a year. We see about 1,300, 1,400 companies a year. So literally 99.5% of the time, right, we won't invest in somebody. But the thought for us is kind of on 2 parts why we still love meeting with entrepreneurs. On the one hand, we would all say we couldn't have started or ran our companies if it wouldn't have been for a lot of free help and advice. I remember walking into the channel advisor offices with Taylor during Shoebox days, picking the great Scot Wingo, spraying on what should we do here and there, right? And I remember during those times, I told a lot of people, entrepreneurs are weird. Literally everybody who are reaching out to and saying, can I pick your brain? Can I buy you a coffee? Everybody says yes, for no apparent reason whatsoever. Yeah. There's nothing in it for them. So there's certainly a kind of pay it forward. And I think we'll all subscribe to the idea of entrepreneurship as a team sport. This is a very collaborative area, I think, too. And there's certainly this idea of, right, we all help each other and what goes around comes around. The other part, however, that we would all say is, since we are a geographically focused investor, whatever happens in this ecosystem is important to us, no matter if it's in our fund or not. When we go out and raise funds, we hear things like, oh, North Carolina doesn't do unicorns, which isn't quite right? Or people will go and be like, nah, I can't invest in Southeast funds. They haven't made returns in the past, or things like that. So in a very genuine way, if Social Institute makes a great exit here, it brings North Carolina on the map. And with that, us, and with that, attracts more entrepreneurs here, gives us more deal flow for future and the like. And the way we look at it with a very long-term lens, I think it's really about, the more we can build in this ecosystem, the better for all of us.
Awesome. Well, we appreciate that mindset you guys have. And I see it every day. You guys are constantly, if there's something too early or something that we can help with, you guys are always open to partnering. And a lot of people say stuff like that. You guys actually do it. We appreciate it. So we're going to enjoy seeing you as a selection committee member in the Tweener Madness. Thanks for giving us the background on you. And we'll see you when we get into the contest.
Thank you very much. I look forward to it.
That's a wrap on this Meet the Judges episode. Now you know the minds behind the decisions, the investors and industry leaders who will be putting these startups to the test. As Tweener Madness kicks off, they'll be asking the tough questions, making the tough calls, and deciding who advances in the bracket, all leading up to the finals in early April. Make sure you're subscribed so you don't miss a single matchup. And if you want to follow along with all things Tweener Madness and the Triangle startup scene, head on over to tweenertimes.com. Also, if you're thinking about launching your own podcast or want to bring professional production to your brand, check out Earfluence.com. The competition is about to begin, and we'll see you soon in the next episode.